Hello and good morning, listeners. This is Almus Market Mornings with Shikhar Garg, bringing in the global financial updates. Folks, there can be some updates on the debt ceiling discussions we've been having in our narratives today as the congressional leaders come into the White House to talk on these fronts. Meanwhile, this week also sees updates on the US inflation along with the updates on the policy stance by the Bank of England. uh, there's one question that JK, I'd like you to talk about whether the BOE will join their counterparts, which set of counterparts, rather, I should say, in their policy stance, whether they'll be pausing or going ahead with an imminent pause or continue on their rate hike trajectory. On the domestic front, our central bank is trading performance will be providing the big dividend payout to the center. So, JK, what are your thoughts? I'd like to know from you.
Yeah. Good morning, Shekhar. So, Bank of England, I think certainly they are going to raise rates today, raise rates this week. Uh, See, their inflation is in double digits compared to the US or Europe, and the real rates in UK is the most negative. So, I don't think they can afford to relax on the inflation. Although there is some assurance from the officials of MPC, or rather the Bank of England, that the past rate hikes impact will be soon felt. But until that is seen in the actual inflation numbers, they are going to be on the action. So this week they will hike rate. June will be something that they will deal with after they have more data with them. And that, as far as the dividend for the government from the RBI this year is concerned, I mean, that is it's too early to say. Yes, of course, I believe if the as per some report that is available to us, RBI has invested quite a bit of their reserves in the treasury bonds, as the as at the end of March 2023, and with yields coming off and the bonds rallying, I'm sure this year they would be making good amount of profit on their investments. And considering the current expectations that the US will be going into a rate cut by late this year, I think these are bound to give some good returns. And while it is too early, I mean, it's not inconceivable that they may be making a good amount of profit on their investments. Coming back to the markets, yesterday we saw some good recovery in yields, with the twos moving up by 10 basis points, tens and 30s by some 7 basis points higher. Apart from profit taking on the long position in bonds created last week in the wake of fresh banking stress, big fresh issuances by Fed weighed on the bond prices, taking yields higher. And adding to the pressure was also corporate issuances totaling 22 billion. So at these lower levels, there is no enough demand to absorb these big supplies. In the meantime, the year-end rate expectations on December, that is December 23, is now showing 66 BPs of cut compared to 73 BPs. So that was being discounted earlier. Now, although stocks also recovered last week's major part of the losses and held their own yesterday, unable to see an uptrend here with so many uncertainties around the regional bank shares, which started well, but that recovery was quite short-lived. Many players quoting rate cut probabilities as support for equities, but in my view, rate cuts may happen mainly on account of onset of recession or a financial crisis, and that kind of development is unlikely to support the stocks. So either way, you see high inflation and high interest rates, or even a rate cut with recession on the cards, we cannot see stock market having a sustainable run. On the contrary, with the downgrade in the corporate earnings, a possibility of bearish move in the stocks is more probable, as far as I am concerned. Also, one cannot expect a positive trend when there is a rising concern about debt ceiling issue and market watching for outcome of proposed Biden meeting with congressional leaders due later today. Investor focus is also on Wednesday CPI data, where the month-on-month is expected to rise from 0.1 to 0.4%. The only moderation is coming in the year-on-year core inflation from 5.6 to 5.5%. Meanwhile, the IMF has said that strong El Ninos can add 4 percentage points to the commodity price inflation, and add to that mix the space for Fed rate cut shrinks definitely from small to probably non-existent. So it's really not given that they are going to cut rates. No official word that any rate cuts are initiated this year, although they will have to look at a lot of data and how the economy evolves, while market seem to be still quite confident that there will be rate cuts by the Fed. Fed is not only going by inflation numbers for their monetary policy, but closely watching at economic activity and the financial sector risks also. Even the market is switching from watching traditional data points to leading indicators like loan numbers. The report on the bank credit supply, as per the survey officer for loans, which something that so far not closely watched. Now it looks like market is latching on to these numbers because the credit conditions are likely to determine how the economy performs going forward. But these data yesterday at least showed that the fall in the rather the rise in the first quarter was much less of credit tightening in aggregate than what the market was expecting. There was only a small uptick in the percentage of banks reporting tightening credit loans. That is 46% of the banks were reporting credit tightening versus 44.8 in Q4 of 2022. The dollar has moved to the higher end of its recent range, with the main influence coming from euro, which has retreated below 1.0990. Even as euro officials keep harping on need for more rate hikes, the region's economic data is raising concerns about growth prospects. Perhaps the impact of rate hikes from minus 1% to around 4% is being felt by the economy. The latest evidence came from German industrial production, which fell by 3.4% in March from 2.1% plus in February. And this also follows a big slump in the industrial dollars data on Friday, which was 10.7% drop. These numbers are not really doing, keeping up the bullish trend of the euro intact, although because of high inflation, Eurozone is also expected to hike its rates further, and the narrowing differential between Europe and US continues to support the euro definitely. But according to most analysts, the risks of a recession in Germany are definitely rising. Higher yields have supported dollar yen, while the GBP has seen some profit taking after it hit 1-year high. Sterling should also be supported ahead of a Bank of England meeting on Thursday with the expectation of another rate rise. Commodity currencies have fared slightly better in the last 2 sessions, being helped by good economic data of the domestic economy in Australia and Canada. And while there has been some cross unwinding of euro longs against these currencies is also seen. As to the rupee, not much there to mention. We are holding on to tight ranges, buffeted by RBI buying on the one side and modest flows from the market. Even exporters are seen selling on any uptick of 5 to 10 paisa in the market. That's on the broader perception that US dollar is likely to be in a downtrend. However, the risk for this is that there can be a sharp recessionary trend in the global economy, and in fact, that is the biggest challenge as far as the Indian export performance is concerned, as per some of the reports that are being circulated. And we see that the RBI might be taking care of these possible developments in the future, and hence keeping the rupee, or rather the dollar well supported at the lower levels. Otherwise, as of now, no major macro points or determining the rupee trend. We still have the domestic inflation on the retail side to be seen on the Thursday of this month. Yeah, thank you.
Okay, JK, that was quite good. And yes, folks, the domestic retail inflation is about to be released on this Thursday, which can give us further updates, as there is some lack of macro indicators for the trend of the pair USD INR. But having said that, double-digit inflation in the UK warrants BOE from joining the counterparts on the action of policy pause, while we see some bit of market participants also watching out for the caution from the US inflation. We have also seen some recovery in the yields, while the market participants continue to talk of rate cuts, which can be supportive of equities. What's interesting though, I found in GK's commentary was, uh, if at all there is any rate cuts, then it has to be in place for the recession mediation and not for support of the equity. So there's this difference in perspectives, which is quite strong and needs to be understood. Furthermore, the inflation expected tomorrow for US, can expect some moderation on the core inflation on YOY basis, but the month-on-month inflation may continue to stay strong. So that's about it on the updates front for today, folks. So we shall come back again tomorrow with another.
Shikhar says a small correction. I think inflation data for India will be announced on Friday, not on Thursday.
Okay. So
Yeah.
With these corrections, we'll take the today's session to a close, and we shall come back again tomorrow for another round of updates. Thank you so much for listening.